Hello investors, welcome to Business Learnings. In this video, we'll talk about the recent 5% correction and whether we'll see more correction in the stock market. What will be the direction of Nifty or Sensex in the next couple of months? We'll try to understand that, and from this crowd of reasons, we'll try to understand the real reason, the real root cause of what causes the markets to move up or move down, so that you can predict on your own. This video might get a little technical, so I'll urge that you watch it multiple times if you wanted to, so that you watch it till the time you understand it, right? Because it's very important that you understand. And do subscribe to the channel, because you won't find this content anywhere else, right? So markets are not governed by these candlestick patterns. Markets are governed by the direction of the big money. By big money, I mean the direction of money of institutional investors. Market has a lot of participants. It has retail investors like us who purchase in smaller quantities, but it has players like FIAs and DIAs who purchase and sell in bigger quantities. So if they dump a lot of shares, the market moves down. If they purchase a lot of shares, the market moves up. If I show you the history of FIIs in the past couple of months, you see February, January, December, November, FIIs have been pouring a lot of money, 42,000 crore rupees, 9,000, 48,000, and that's what has been driving the market up. But going forward, they will start selling and they will start taking out money from India. And that will be the time when the markets will start showing its true colors, when the markets will start crashing, correcting, right? And why will it happen? It will happen because FIIs were pouring money into India because they didn't have better option. Think from the perspective of an FII. To generalize an FII, I'll consider a mutual fund based out of the United States. Where exactly can they invest in? They have four options to invest in. First, keep all the money in cash. But keeping cash doesn't earn any interest. Second option, invest in the US bonds. Invest in US 10-year bonds because they are the safest bond options. But they are not yielding good enough returns, just 0.7, 0.8% of returns in the past 1 year. You see June, October, November, they were just yielding about 0.7% of interest. Third option, invest in US equities, but their valuations are already sky high. The fourth and the final option is invest in emerging economies, for example, India. And that's what they did. And they were expecting a lot of return. They made a lot of return. But now that the bond market is rising, the bond market yield is rising. Investing in 10-year US bond will now yield about 1.71% interest returns per year. Why wouldn't they invest here? Earlier, they didn't invest because the returns were just 0.7%, and now it's 1.71%. That's the reason. You see, from the past 2 months, the bond yields have rallied a lot. And that's the reason in the past 2 months, Indian stock markets have plateaued. And from this, it can only move downwards. The reason being, these yields will keep on rising. Yields will keep on rising because inflation has already started showing its true colors in the United States. If you see, oil prices are moving up, metal prices are moving up. Oil and metal are towards the center of any industry, automobile industry or steel industry, textile, any industry you go in, they will need fuel, they will need metal machineries, right? So metals and oil, they are towards the center of any industry, and their prices have started moving up, which means the product prices will start moving up, which means inflation will happen. Inflation has already started happening, and inflation will keep on happening. It will keep on rising in the next couple of months. Now, what you'll ask me, what does inflation have to do with the bond yields? First, just tell me, you have understood this much, that if these bond yields will keep on rising, the Indian stock market will keep on falling, right? Because investors will pull out their money from Indian stock market and invest in the US bond market because this is giving better returns, right? You have understood this much. Now, if inflation starts happening, inflation means the prices of goods are rising, right? So there is a lot of money in the system while the amount of goods and services is just this much. So in order to control the inflation, the amount of money in the system, in the countries, in the economy has to lower down, has to be cut. And that's what the role of RBI is in India. That's what the role of Federal Reserve in the United States, right? So United States will have to cut money supply in the United States economy. How will it do that? It will do that by increasing the interest rates. If it increases the interest rates, what happens? People borrow less, because who wants to take loan on 4% interest rates when they are getting it for 2% right now? In the United States, the current interest rates are less than 1%. So a lot of people and businesses are borrowing money because interest rates are way cheaper. If interest rates move up, they'll stop borrowing. Who wants to pay for 3 or 4% interest, right? So when they'll stop borrowing money, the amount of money in the system will automatically drop and inflation will be under control. And since inflation will happen, although United States government has said that they will not cut the rates in the next couple of years, but as inflation will happen, they will be forced to cut rates, and that's what the market knows. And that's why the yields of these bonds have been rising. Because when interest rates will rise, the newer bonds that will be issued, they will be issued at higher interest rates. So why not buy those rather than sticking with these who are just offering me 1.7%? Why not wait for the newer bonds which will give me 2%, 3% interest rates? That's what has been happening. And people are the bond investors, the equity investors, they are selling equity and buying US 10-year bonds. And the bond investors, US 10-year bond investors, they are selling the 10-year bonds and they are purchasing US 1-year bonds. They are purchasing US 10-year bonds, and that's why their yields have been going down. Price of a bond is inversely correlated to its to the interest rate. Price of a bond is inversely correlated to its yield, and that's why there is a lot of buying in the short-term bonds, and there's a lot of selling in the long-term bonds. That's why these yields will keep on rising because of the inflation expectation. And if this keeps on rising, the Indian equity market will keep on falling. That's what the expectation is for the next couple of months, and that's why Nifty has almost plateaued, and it's very unlikely that it will be able to break out its all-time high. So that's what my understanding is, and I'm sure that this might have gotten a little complicated, but if you really understand this, watch it again. The parts you didn't understand, I'll urge you to Google it and understand, because if you are directly investing in the stock market, you must understand the bond market, because the bond market is what eventually drives the stock market. Bond market of the United States is what eventually drives the equity markets of the Indian stock market. Right? So do like the video, do comment with your questions, do subscribe if you like my content, and thanks a lot for watching this far. See you in the next video.